Why do some people turn a few $100s into life-changing wealth in crypto, while others lose everything trying to do the exact same thing? Same market, same coins, same information, different results. And I'm not talking about luck. I'm not talking about timing. I'm talking about something much deeper, something that separates the people who actually win in this space from the overwhelming majority who walk away broke, confused, and bitter. Today, we're going to talk about that thing. We're going to name it, break it down, and by the end of this video, you're going to look at your own crypto journey and either say, that's exactly what I've been doing wrong, or finally, someone said it out loud. Because here's the uncomfortable truth. 99% of people who enter the cryptocurrency market will never get genuinely life-changingly rich from it. Not because crypto doesn't work, it clearly does. Not because the opportunity isn't real, it clearly is. But because of a specific set of behaviors, beliefs, and blind spots that almost nobody talks about honestly. The 1% isn't smarter than you. They're not luckier than you. They just operate by a completely different rulebook. And today, I'm handing you that rulebook. Let's get into it. Part 1. The lottery ticket mindset. Why most people enter crypto for the wrong reason. Let me ask you something honest. Why did you first get into crypto? Was it because you deeply understood blockchain technology and believed in the long-term restructuring of global financial systems? Or was it because you saw someone post a screenshot of their gains and thought, I want that? Be honest with yourself, because for the vast majority of people, and I mean the overwhelming, staggering majority, crypto was never a financial strategy. It was a fantasy, a lottery ticket with better branding. And there's nothing wrong with wanting financial freedom. That desire is completely valid. But the way most people enter this market, chasing a viral tweet, buying a coin because a celebrity mentioned it, throwing money at a token with a dog on it, that's not investing. That's gambling. And the casino always wins. Here's what makes crypto uniquely dangerous in this regard. Every other major asset class has gatekeepers. To invest in private equity, you need to be accredited. To trade complex derivatives, you need approval. To buy certain securities, there are restrictions and minimums. But crypto? Crypto has no gatekeepers. A 17-year-old in his bedroom and a hedge fund manager in Manhattan are operating in the exact same market at the exact same time with the exact same access. And that sounds like democracy. It sounds like equality. But what it actually is, in practice, is a feeding ground. Because the hedge fund manager, he has risk management teams, he has analysts, he has stop-loss systems and portfolio hedging and emotional distance. The 17-year-old, or the regular person just trying to change their life, has none of that. They have a Coinbase account and a dream. The 1% understands something critical. Crypto is not a lottery. It is an asymmetric opportunity, and asymmetric opportunity rewards preparation, not impulse. Let me give you a real example. When Bitcoin first crossed $1,000 in 2013, the mainstream narrative was that it was a bubble, a scam, a tulip mania for nerds. Most people who heard about it dismissed it. A small group studied it, understood the underlying technology, understood what decentralized money actually meant, and they positioned themselves. When it crashed back down to $200 in 2015, the lottery ticket crowd sold in panic and swore off crypto forever. The 1% bought more, not because they were reckless, because they had conviction based on understanding, not hype, understanding. The mindset shift from I want to get rich quick to I want to understand what I own and why is the single most important transition any crypto investor can make, and most people never make it. They stay in lottery ticket mode forever, jumping from coin to coin, chasing the next 1000x, never stopping to ask, do I actually understand what this project does? Part 2. The information trap. Why knowing more can make you poorer. Here's something that's going to sound strange. Most crypto investors lose money not because they don't have enough information, they lose money because they have too much of the wrong kind. We live in the most information-saturated period in human history, and nowhere is this more true than in the crypto space. There are thousands of YouTube channels, Twitter accounts, Telegram groups, Discord servers, newsletters, podcasts, all of them screaming at you about what to buy, when to sell, what's about to explode, what's about to collapse. And here's the trap. All of that content feels like research. It feels productive. You're spending hours every day consuming information about crypto. You must be getting smarter, right? You must be building an edge. But here's the reality. 90% of crypto content online is not designed to make you wealthy. It is designed to keep you watching, keep you clicking, and keep you emotionally activated. Because emotional activation drives engagement, and engagement drives revenue. Think about the incentive structure. A YouTube creator doesn't get paid when you make a profit. They get paid when you watch their video. A Twitter influencer doesn't earn when your portfolio grows. They earn when you retweet their prediction. A crypto project's marketing team doesn't benefit from your long-term gains. They benefit from driving up price in the short term so early investors can exit. These incentives are completely misaligned with your success. Completely. And yet, most people are building their entire investment strategy around content created by people with misaligned incentives. The 1% have a very different relationship with information. They don't consume more, they consume better. They go to primary sources, white papers, on-chain data, protocol documentation, developer activity on GitHub. They track what wallets are actually doing, not what personalities are saying. There's a concept in investing called signal versus noise. Signal is the information that actually matters for making good decisions. Noise is everything else. In the crypto information ecosystem, the ratio of signal to noise is probably 99:1, and most people are drowning in noise while thinking they're absorbing signal. Let me give you a framework. Next time you're about to make a crypto investment decision, ask yourself where this information came from and what does that person gain if I act on it. If the answer is that they gain views, clicks, affiliate commissions, or token price appreciation, treat that information with extreme skepticism. Not dismissal, but skepticism. The 1% are ruthless about this filter. They understand that in a market full of noise, the ability to find and trust real signal is one of the most valuable skills you can develop, and it's a skill almost nobody in the 99% ever develops because it's harder and less exciting than watching a YouTube video that tells you exactly what's going to pump next week. Part 3. The volatility paradox. How the thing that creates wealth destroys it for most people. Let's talk about Bitcoin for a moment. From January 2020 to November 2021, Bitcoin went from roughly $7,000 to nearly $69,000. That is almost a 900% gain in less than 2 years. If you had put $10,000 in at the start of 2020 and simply held, you would have had close to $100,000 by the peak. Simple, right? Just hold. Easy money. Except, here's what actually happened to the average retail investor during that same period. Bitcoin dropped 50% in March 2020 when COVID hit. Most people panic sold. They couldn't take it. Then it recovered and went higher. Some of those people bought back in. Then the dip again in the summer, more selling. Then the massive run began. People who had sold low bought back in higher because now there was confirmation. Now there was hype. Now it felt safe. Then came the China mining ban in May 2021, another 50% crash, more panic selling, then the recovery to $69,000. You see the pattern. The chart looked like an obvious win, but the actual experience of living through that chart with real money on the line, with your emotions responding to every dip and every headline, was a gauntlet that destroyed most people's returns, even in a bull market. This is what I call the volatility paradox. Volatility is the engine that creates crypto's extraordinary return potential, but volatility is also the mechanism through which most people lose money. The same force that makes a 10x return possible is the same force that makes you sell at the bottom and buy at the top. The reason this happens is deeply human. Our brains are not wired for modern financial markets. We evolved to avoid loss more than we seek gain. It's called loss aversion, and it's one of the most well-documented phenomena in behavioral economics. Nobel Prize winner Daniel Kahneman spent decades studying this. The pain of losing $100 is psychologically about twice as powerful as the pleasure of gaining $100. In normal life, this is a useful survival instinct, but in crypto markets, it is catastrophic because crypto is specifically designed by its nature to trigger loss aversion at the exact wrong moments. When Bitcoin drops 30% in a week, every cell in your body is screaming, "Sell!" Your brain is pattern matching to danger. Get out, protect what you have. And most people listen to that voice, and most people are wrong. The 1% understand something critical. They've trained themselves to override this impulse, or they've structured their investing in a way that removes the emotional decision-making entirely. Dollar-cost averaging, putting in a fixed amount at regular intervals regardless of price, is one of the most powerful tools for this. It sounds boring, it sounds too simple, but it works precisely because it removes emotion from the equation. The other thing the 1% do is they size their positions correctly from the start. If you invest more than you can psychologically and financially afford to lose, you will eventually make an emotional decision. It is not a matter of willpower, it is a matter of how humans are wired. If you've put your rent money into Ethereum, you are going to sell when Ethereum drops 40% because you have to, or because the psychological pressure becomes unbearable. Position sizing is not exciting, risk management is not exciting, but it is the difference between staying in the game long enough to win and getting knocked out in round 1. Part 4, the altcoin graveyard, the brutal math most people ignore. I want to show you something that most crypto content won't show you because it's not exciting and it doesn't drive engagement. Go look at the list of the top 100 cryptocurrencies by market cap from 2017, the ones that were being talked about everywhere, the ones that had passionate communities and massive promises and YouTube channels dedicated to them. Now go look at what happened to most of them. XRP was $3.84 in January 2018. Years later, it's still struggling to get back to that level when you account for everything that happened between. Verge, which was described as a privacy coin that would compete with Monero, went from nearly 30 cents at its peak in 2018 to fractions of a cent. BitConnect, which promised revolutionary lending returns, turned out to be one of the largest crypto Ponzi schemes in history. Millions of people lost everything. These aren't obscure examples. These were some of the most hyped projects of their era. Projects with millions of followers, celebrity endorsements, and passionate retail investors who did research, meaning they watched videos, read Reddit threads, and followed Twitter accounts. And here's the brutal math that most people in the 99% never run. In a typical crypto bull market, out of every 100 altcoins that gain significant attention and investment, roughly 5 to 10 will survive the subsequent bear market with meaningful value intact. The other 90 to 95 will decline by 80%, 90%, 95% or more, and many will simply cease to exist. Think about what that means in practice. If you're picking altcoins based on hype, momentum, and social media sentiment, which is how the vast majority of retail investors operate, you are playing a game where the base rate of success is somewhere between 5 and 10%. Those are not investing odds. Those are lottery odds. The 1% understand that in the altcoin market, the burden of proof is extreme. It is not enough for a project to have a good white paper. It's not enough to have a charismatic founder. It's not enough to have a large Twitter following or a passionate Discord community. You need to be able to answer a very specific set of questions. What actual problem does this blockchain solve that existing solutions don't? Does this project have real revenue, or is the entire economic model dependent on new investors buying in? Is there genuine development activity, or has most development stalled? What happens to the token price if no new money enters the ecosystem? Most altcoins fail these questions. Most altcoins are not solving a real problem. They are creating a token and building a community around speculative price appreciation. And that works for a while in bull markets when new money is flowing in and enthusiasm is high. But the moment the bull market ends, those projects collapse like houses of cards. Bitcoin is different in a specific way. Bitcoin has a 15-year track record. It has survived multiple 80% plus crashes and come back higher each time. It has no founder who can be arrested or discredited. It has no central team that can change the rules. It has no marketing budget, yet it has more brand recognition than 99% of crypto projects. Its security model has never been successfully attacked. These are not guarantees of future success, but they are fundamental properties that most altcoins simply do not have. The 1% either concentrate heavily in Bitcoin and Ethereum, the two assets with the deepest liquidity and longest track records, or they are extraordinarily selective and disciplined about which altcoins they touch, and they treat those altcoin positions as high-risk bets, not core holdings. The 99% do the opposite. They treat Bitcoin as too slow and already had its run, and concentrate in low-cap altcoins with exciting stories, and they lose. Over and over again. Not because they're stupid, because the math was always against them, and nobody was honest enough to tell them. Part 5. The tax and cost blind spot, the silent wealth destroyer. Here's one that almost nobody talks about in crypto content, and I mean almost nobody. You've probably seen the stories. Someone buys Bitcoin at $1,000, sells at $50,000, makes a fortune. Or someone buys an altcoin at a penny, it goes to $1, they made 100x. The math looks obvious, the gains look undeniable. But there are two silent destroyers of crypto wealth that the 99% almost universally ignore until it's too late, and by the time they realize it, the damage is done. The first is taxes. In most countries, including the United States, the United Kingdom, most of Europe, and increasingly everywhere else, cryptocurrency is treated as a taxable asset. Every time you sell a cryptocurrency for a profit, you owe tax on that profit. In the US, if you've held for less than a year, short-term capital gains rates apply, which can be as high as 37% at the federal level for high earners, plus state taxes. Even long-term capital gains for assets held over a year can be 20% or higher. Now think about the typical 99% crypto investors' behavior. They're trading frequently, moving between coins, taking profits, reinvesting, taking more profits. Every single one of those transactions is a taxable event, and many of them are short-term gains, taxed as ordinary income. There's a famous pattern that plays out in every bull market. Retail investors run up massive paper gains during the bull run, trading constantly, reinvesting profits into new coins, never stopping to account for the tax liability they're accumulating. Then the bear market hits. Their portfolio drops 70, 80, 90%. But the IRS doesn't care that your portfolio dropped. They care about the gains you realized during the bull run. And now you owe taxes on profits that no longer exist. This has financially destroyed people. Not exaggerating, there are documented cases of investors who owed 6- and 7-figure tax bills from their bull market trading, found themselves unable to pay, and faced serious legal consequences. The 1% work with accountants who specialize in crypto taxation from day one. They structure their investing, holding periods, tax loss harvesting, entity structures, specifically to minimize the tax drag on their returns. This is not exotic or illegal, it is standard wealth management. But most retail investors never think about it until they're sitting across from a terrifying tax bill. The second silent destroyer is fees, and this one is particularly insidious because the fees are often invisible. Gas fees on the Ethereum network can range from a few dollars to hundreds of dollars per transaction during periods of high congestion. Swap fees on decentralized exchanges, trading fees on centralized exchanges, spread costs, withdrawal fees, management fees on crypto investment products. For small investors making frequent trades, these fees can represent a staggering percentage of their overall returns. Someone with a $5,000 portfolio making 20 transactions a month, each with $15 in fees, is spending $300 a month, over $3,600 a year just in transaction costs. That's 72% of their initial capital gone to fees in a single year. The 1% are obsessive about fee minimization. They batch transactions. They choose networks with lower fees for appropriate use cases. They use exchanges with competitive fee structures. They are disciplined about transaction frequency. These might sound like minor details, but over years, compounded, they represent the difference between wealth preservation and wealth erosion. Part 6, the cycle blind spot, why most people are always one step behind the market. Let me paint you a picture that you're going to recognize immediately. It's late in a bull market. Bitcoin has gone from $20,000 to $70,000. It's been on the news, your relatives are asking you about it at family dinners, taxi drivers are giving you crypto tips. Everyone seems to be making money. The fear of missing out is overwhelming, and that's when you, or most people, finally decide to get serious about crypto. Or maybe it's the opposite. It's deep in a bear market. Bitcoin has crashed from $70,000 to $16,000. Every headline is about the crypto industry collapsing. FTX just imploded. Three Arrows Capital is gone. Celsius is bankrupt. Every influencer who was calling for a $100,000 Bitcoin has gone silent or pivoted to talking about AI. And that's when most people, the ones who bought near the top, finally give up and sell. If you recognize yourself in either of those descriptions, you've just identified one of the most fundamental and destructive patterns in retail investing, buying high and selling low, and it is almost universally driven by one thing: sentiment. Humans are social creatures. We are deeply influenced by the emotional state of the people around us. When everyone around us is excited and making money, we feel the pull of that excitement. When everyone around us is panicking and losing, we feel that panic too. And in financial markets, following the crowd sentiment almost always means being exactly one step behind the smart money. This is not a new phenomenon. In 1841, journalist Charles Mackay wrote a book called Extraordinary Popular Delusions and the Madness of Crowds, documenting financial manias throughout history: the tulip mania of the 1600s, the South Sea bubble, the telebubble of the 1700s. The pattern is always the same. Early adopters identify an opportunity, price rises slowly, then public attention catches on, price accelerates, FOMO drives buying, price becomes completely detached from underlying value. Then the early adopters sell to the latecomers. The music stops, the crash comes, and the people who got in because of hype are left holding the bag. Crypto does not invent this pattern. Crypto just runs it faster, louder, and more frequently than almost any other asset class in history. The 1% understand crypto market cycles deeply. They understand that Bitcoin has historically operated in roughly 4-year cycles, loosely correlated with the halving events that reduce Bitcoin's new supply issuance by 50% roughly every 4 years. They understand that bull markets tend to follow halvings by 12 to 18 months, as the supply shock works through the market. They understand that the peak of a cycle is characterized by extreme mainstream attention, unsustainable price acceleration, and the kind of euphoria that makes everyone feel like a genius. They use that understanding to position differently than the crowd. They accumulate during the periods of maximum pessimism, the periods when everyone is saying crypto is dead, when the news is terrible, when prices are suppressed. And they take profit, not all of it, but meaningful portions, during the periods of maximum euphoria, when everyone is making price predictions that sound insane in hindsight. Be fearful when others are greedy, and greedy when others are fearful. Warren Buffett said that about traditional markets, but there is no market in the world where this principle applies more powerfully than cryptocurrency. The swings between fear and greed are more extreme in crypto. The cycle is more pronounced, and the rewards for understanding and acting on this cycle versus getting swept up in it are correspondingly enormous. Part 7. The Identity Trap. the psychological poison killing your portfolio. This last point is the one nobody wants to hear, but I think it might be the most important of everything we've talked about. Many people in the crypto space have made their cryptocurrency holdings part of their identity. They are a Bitcoin maximalist. They are an Ethereum bull. They are a holder of a specific altcoin that they believe in deeply, personally, and they have tied their sense of self-worth to the performance and eventual success of that asset. This is an incredibly dangerous psychological position to be in. Not just financially dangerous, psychologically dangerous. When your investment becomes part of your identity, rational decision-making becomes almost impossible. You can no longer evaluate evidence objectively. Negative news about your coin feels like a personal attack. You seek out and amplify information that confirms your thesis and dismiss or explain away information that contradicts it. This is called confirmation bias, and it's one of the most destructive forces in investing. You've seen this play out publicly, loudly, constantly in crypto communities. Bitcoin maximalists who refuse to acknowledge any legitimate innovation in the broader blockchain space, missing extraordinary opportunities in Ethereum and other sectors. Ethereum supporters who ignored serious on-chain metrics showing weakness going into bear markets. Altcoin holders who held bags down 95% because selling would feel like admitting defeat, like admitting they were wrong. The market does not care about your identity. The market does not care about your thesis. The market does not care about how many hours you've spent researching a project, how many videos you've watched, how passionately you believe in the team. The market is a mechanism that aggregates the decisions of millions of participants, and it will do whatever it does regardless of your personal conviction. The 1% treat their cryptocurrency positions as financial instruments, not as expressions of who they are. They can change their mind. They can sell something they previously believed in when the fundamentals change. They can buy something they previously dismissed when the data shifts. They are not loyal to assets. They are loyal to outcomes. This emotional detachment is genuinely hard to develop, especially in crypto where community and shared belief are so central to the culture. Being part of a passionate crypto community can feel deeply meaningful, but you have to be able to separate the community, which might be genuinely valuable, from the financial decision-making. Those two things need to operate completely independently. One practical tool the 1% use, they regularly play devil's advocate against their own positions. They force themselves to write out the strongest possible argument against their biggest holdings. Why might Bitcoin fail? What are the real risks to Ethereum's dominance? What are the 3 most convincing arguments that this altcoin I hold is overvalued? If you can't make those arguments clearly and honestly, you don't understand your investment well enough, and your inability to make those arguments is probably identity protection, not genuine analysis. So, let's bring this all together. The 99% enter crypto with a lottery ticket mindset, chasing quick wealth without a genuine understanding of what they own. They drown in noise while calling it research. They make emotional decisions during volatility that destroy their returns in markets that should have made them wealthy. They chase altcoins with catastrophic base rate odds. They ignore the silent destroyers of taxes and fees until it's too late. They let crowd sentiment determine their timing, always arriving one step behind the smart money. And they protect their identity at the cost of their financial future. None of these are intelligence failures. Every single one of them is a behavioral pattern. They are things people do, and things people do can be changed. The 1% are not operating with some secret information that isn't available to you. Everything I've talked about in this video, market cycle psychology, information filtering, position sizing, tax strategy, on-chain research, all of it is learnable. All of it is accessible. The internet has democratized access to financial knowledge in ways that were unimaginable 20 years ago. What the 1% have is discipline, patience, emotional control, a process that they follow consistently, regardless of what the crowd is doing, regardless of what the headlines are saying, regardless of how exciting or how terrifying the market feels in any given moment. The most powerful thing you can do right now, today, after watching this video, is this. Slow down. Before you make your next crypto investment decision, ask yourself whether it comes from genuine understanding or from excitement and FOMO. Before you consume your next crypto content, ask what the creator's incentive structure is and whether their interests align with yours. Before you sell in a panic, ask whether you're responding to the market or to your emotions. Before you put more into an altcoin, run the brutal math on the base rate odds and make sure you're sizing the position appropriately. Crypto is one of the most extraordinary financial opportunities in human history. The technology is real. The transformation of global finance is happening. Blockchain is not going away. Decentralized systems are not going away. Digital scarcity is not going away. The opportunity is real. But opportunity without discipline is just risk. And most people in this space are all opportunity and no discipline. And that's why 99% will never genuinely get rich from it. You now have the map. What you do with it is entirely up to you. If this video added real value to your thinking about crypto, not just hype, but genuine frameworks, consider subscribing, because that's what this channel is about. Not telling you what to buy or when to sell, but giving you the mental models and the honest perspective that most crypto content is too incentivized to give you. See you in the next one.